A retirement account statement may appear stable with bonds, but over the years, the balance rarely shows meaningful growth. Reports of market crashes make stock investing seem risky, leading many to adopt a cautious and sometimes avoidant attitude. This fear intensifies when investing is portrayed as a game dominated by insiders with complicated strategies and swift actions. When investing becomes technical and intimidating, many choose to delegate decisions or stick to the perceived safest options. Over the years, this low growth can result in insufficient savings to meet rising living costs and extended lifespans. Small annual differences in returns can compound into significant limitations on freedom, choices, and financial resilience. In everyday life, there are often hints about businesses, products, and industries that experts might overlook. By combining these hints with fundamental research, stock decisions can shift from feeling like mere guesses to informed choices. This discussion will explain why stocks are vital, how everyday investors can succeed, and the research habits that help minimize avoidable errors. This video draws inspiration from Beating the Street by Peter Lynch and John Rothschild, so remember to subscribe for more insights. Everyday investors can outperform professionals by concentrating on what they truly understand while avoiding the herd mentality. Without the pressure of clients, committees, or daily performance metrics, investment decisions can remain straightforward and patient. Professionals often manage large sums of money, which can dilute even the best ideas across numerous positions. The need to steer clear of smaller companies can mean missing out on some of the most promising growth opportunities. A 7th grade class managed a small portfolio, selecting companies they could explain and diligently tracking the outcomes. Their selections nearly outperformed all mutual funds over 2 years because simplicity triumphed over complexity. The takeaway isn't that children are investment experts, but that clarity and focus can provide a genuine competitive advantage. A straightforward explanation filters out transient trends and keeps your attention on strong businesses with consistent demand. Identify a few companies related to products or services you encounter regularly, then write a single sentence explaining their demand. Keep that sentence alongside your notes so future data either confirms your insight or prompts a reassessment. Choosing between stocks and bonds ultimately boils down to a choice between growth potential and stable income over the long term. Bonds may offer short-term stability, but their income doesn't inherently rise with inflation. Given increasing lifespans and persistent inflation, a portfolio should prioritize growth, not just reliable interest payments. If returns lag for 2 decades, you'll need to contribute much more later just to catch up. In one analysis, a bond-centric strategy generated interest income, but ultimately maintained the original principal without growth. Conversely, focusing solely on stocks resulted in increasing dividend income and a significantly larger value over time. This illustrates why stock ownership should be viewed as a practical tool for financial health rather than a gamble. The aim is to secure future purchasing power and flexibility, rather than just achieving tranquility in the quarterly statements. First, clarify what the funds will support and then determine the stock allocation based on your investment timeline. Create a regular rebalancing schedule to ensure that fear and sensational headlines don't alter your plan. Smart stock decisions stem from merging common sense about a business with easily verifiable facts. This balance helps you avoid the pitfalls of vague storytelling without data and complex math without comprehension. Relying too heavily on software and digital charts can overlook critical risks found in financial statements and market dynamics. Conducting your due diligence minimizes the chances of investing in the latest trend just before it falters. If you're a part-time stock picker, focus on a few standout investments to maximize your efforts on a compact list. With just 5 investments, a single 10-fold return can compensate for several underperformers and enhance your overall results. Approach investing as an investigation, ensuring that every claim about a company is subject to quick and thorough verification. The aim isn't to achieve certainty, but to establish solid reasons for owning a stock and clear justification for avoiding others. Begin by exploring various ideas, then keep only those that maintain their appeal after thorough analysis. If this framework aids your decision-making process, subscribe for more practical insights that you can implement right away. Businesses that interact directly with consumers provide clear indicators. As customer behavior reveals demand through repeat transactions and tendencies. Observing store environments to see product performance can generate leads more efficiently than sifting through endless ticker symbols. Popular items often signal pricing power and potential for growth, which will eventually be reflected in earnings and cash flow. Buying when a story is already widespread often results in paying for optimism already factored into the stock price. One household witnessed a beverage brand dominate their refrigerator and later discovered that the stock had already surged. This scenario illustrates the importance of early observation, followed by quick evaluations of growth and financial stability. Retail insights are most beneficial when they lead to careful follow-through, rather than impulsive buys based solely on personal taste. The same shopping excursion can also uncover red flags like excessive discounting, surplus inventory, or declining customer traffic. Maintain an ongoing list of brands and retailers that seem to capture market share, then confirm the sales trends behind them. Treat every promising observation as a question to explore further, allowing the data to guide your conclusions. Companies in cyclical industries fluctuate alongside broad economic cycles, leading to predictable patterns in their earnings. A low price-to-earnings ratio can be deceptive if earnings are temporarily inflated during peak market conditions. Purchasing during optimal circumstances may seem affordable, but shrinking profits can quickly lead to falling stock values before bad news becomes apparent. Keeping an eye on industry supply, demand, and debt levels is critical to predicting turning points beyond just recent earnings reports. For instance, a metals producer might report record profits late in an economic cycle, making the stock appear like a bargain. When the market reverses, that same company can suffer losses, teaching earlier investors why the perceived value was misleading. Bad news can create opportunities when prices are in a temporary decline, even if it feels like a permanent situation. The key is to remain grounded, avoiding euphoria at market peaks and paralysis when negativity takes center stage. Prior to investing in a cyclical industry, assess where the sector stands in its cycle and identify signs of potential recovery. Monitor inventory levels, changes in capacity, and pricing movements, taking action when conditions shift rather than following headlines. Achieving returns that surpass market averages comes from steering clear of easily avoidable mistakes and allowing a few strong decisions to drive your outcomes. The most effective strategy is to focus on real businesses, buying only those that you can thoroughly understand and explain. Leverage time to favour growth investments over fixed income, particularly when long-term horizons and inflation make stagnant options less viable. Seek inspiration for ideas in your daily life and rigorously research them through valuation analysis and an understanding of market cycles. Patience allows successful investments to evolve into significant positions, while discipline ensures that one poorly timed choice doesn't derail your progress. This combination fosters confidence as you have clarity on each investment's purpose and exit strategy. Select one company that resonates with you, analyze its fundamental financial statements, and outline the critical factors that must remain true for your investment thesis. Review your notes periodically throughout the year, making updates based on factual changes rather than emotional shifts. With time, your focus will shift from trying to predict market movements to cultivating a consistent and disciplined investment habit. Subscribe to gain access to more frameworks aimed at making investing clearer, calmer, and more evidence-based as you progress.